Hi, this is Priyadarshini from Adhyapana Academy, and I'm here to present demo on strategic financial management. Okay, so today I will be giving a demo on the topic of capital budgeting, where we will be discussing the concept of net present value. Net present value is NPV in short. It is nothing but the sum of present value of cash inflows minus the sum of present value of cash outflows, right? So if the NPV is positive, a project is recommended to be accepted. If the NPV is negative, the project is recommended to be rejected. And if the NPV is zero, it is a point where it is indifferent to acceptance or rejection of the project. This is a point which is called as IRR, internal rate of return, or the minimum required rate of return for the project. Now let me tell you the logic behind computation of net present value and what are the inclusions and exclusions in calculating the NPV. This NPV is nothing but the benefit derived if a long-term proposal is accepted. The amount of benefit which is derived if a long-term proposal is accepted is what we call as net present value. This net present value is the net benefit which is derived because of accepting the project, right? So it is the sum of inflows minus the sum of outflows, but we are bringing it to present value terms. So let me just give you a random example. Say rupees 10 lakhs is invested in a machinery in year zero. Year zero is nothing but the present as of now. The present is what you call as the present time or the present date, or now is what you call as year zero. Suppose 10 lakhs is to be invested in a machinery. How will I decide whether I will invest this 10 lakhs in that machinery or not? I will make an estimate, or I will have an estimate of how much of revenue is going to be generated over the life of the machinery. Suppose, say, the life of the machinery is 5 years. In that 5 years, I have to recover the original investment, and along with it, I have to make some amount of benefit. Correct? So, how much is my estimated future cash flows? Estimated future cash flows because of investing in this 10 lakhs will be either given or you will find. Okay. How am I going to calculate this cash flows? It is earnings before depreciation and tax minus depreciation, which will give you earnings before tax, minus tax, which will give you earnings after tax. To this, you add back depreciation, you will arrive at cash flows after taxes, right? This cash flows after taxes will be estimated for the future period, which is for the life of the machinery, which is expected to be purchased. Once I find the cash flows after taxes, it is for subsequent years, which is year 1, 2, 3, 4, and 5, right? Say, suppose the cash flows are random numbers. Just example, 1,50,000, 2,50,000, 3 lakhs, 3,50,000, and say 4 lakhs. Suppose these are the cash flows which is given. This cash flows is expected at the end of the following years, in which case I have to discount them to present value terms to decide in year zero whether the investment in 10 lakhs of machinery should be made or not. So how do I discount these cash flows? It is based on a simple concept of time value of money. You might have learned from your childhood A is equal to P into 1 plus R to the power of N. This is the compound interest formula. So this A, I can write it as future value of money is equal to present value of money, which is compounded at a rate of return for n years, right? So here, the future value of money, which is known to me for the 5 years, when I divide it by 1 plus r to the power of n, I will be getting the present value of money. So what is this 1 divided by 1 plus r to the power of n? This is what you call as the present value factor, where r is the cost of capital for investing in the project. that cost of capital is influenced by inflation as well, right? So that cost of capital should be after tax cost of capital. So the present value factor, say suppose at 10%. How do I find the present value factors? It is 0.909. I know these numbers by practice. 0.826, 0.751, 0.683, 0.621, and so on. Right? How did I get these numbers? For the first year, it is 1 divided by 1.1 to the power of 1. For the second year, it is 1 divided by 1.1 to the power of 2. For the third year, it is 1 divided by 1.1 to the power of 3. For the fourth year, it is 1 divided by 1.1 to the power of 4. For the fifth year, it is 1 divided by 1.1 to the power of 5. I will tell you a shortcut for this calculation. In your calculator, if you apply 1 divided by 1.1, you will get 0.909. For the subsequent years, it is enough if you press only the equal to symbol, you will automatically arrive at the subsequent numbers. Suppose if after pressing equal to symbol, you don't get this 0.826, what you will do is you get 0.909 in year 1. Then for year 2, again divide by 1.1, you will get 0.826. For year 3, again divide by 1.1 to the resultant number. Resultant number will be 0.826. Again divide by 1.1, you will be getting 0.751. Again divide by 1.1, you will be getting 0.683 and so on. So after you get the present value factors, the cash flows is multiplied with present value factors to arrive at the present value of cash inflows. That is the future cash inflows. The future cash inflows are discounted in present value terms to arrive at its value as in year 0. So the cash flows into present value factor will give you the present value of cash inflows. Add them all and subtract with present value of cash outflows. You will arrive at the benefit derived because of investing in the machinery. Once that benefit is positive, you would say accept the project. So as part of these cash flows, at the end of the project, you will have two different cash flows to be added. One will be at the end of the project, you will have another cash flow to be added, which is called as terminal flow. There are two components of terminal flow. One will be the scrap realization because of investing in the machinery, and the other will be the recovery of working capital. So now what is this working capital which I am talking of? Investment in a particular machinery, for the example which I gave you, 10 lakhs. For the investment in machinery, the machinery cannot run on its own and produce goods and generate revenue, right? You need raw material to produce goods. You need laborers to handle the raw material. Then once the goods are produced, when it is marketed and if it is sold on credit sales, it moves to the hands of debtors. And then from debtors, you realize money. So there is investment required in working capital also to generate the revenue. So add that investment in working capital, will be added to original investment when it is made. Original investment when it is made. I am not mentioning it as investment in year 0. Not necessary that all the amount of investment should be made in one shot at the beginning of the project. Investment can be made multiple times during the life of the project, right? That is why I say investment in working capital is added to original investment when it is made. Later, at the end of life of project, what will happen? At the end of life of project, the organization is going to generate the entire investment it made into revenue, correct? So whatever is locked up in working capital will be recovered at the end of life of the project. That is why it will be included as part of terminal flow at the end of the 5th year. Excuse me. So in the 5th year, as part of cash flows, it is not just the cash flows which is recovered in terms of revenue made by the organization. It will also include the scrap realized because of disposing the machinery and will also include recovery of working capital. In that scrap realization, in case if the scrap realized is a gain, you will account for capital gain, taxes, and then show the net scrap realized. As part of outflows, it is the original investment which is made in the machinery, and you will also include the working capital which is invested. You have to bring it also in present value terms to net it out to know the amount of net present value.